That sounds great.
Perfect. Great. So we are live. Hey guys, thank you all for joining us today in this hackathon. And this is a very interesting hackathon that we're going to conduct today. It's an economic hackathon, obviously, which means that we have now with us a group of economists who are going to ideate on different things for a very particular problem, which I will describe momentarily, right? So the way this is going to get played out is that we have a set of panelists with us who are experienced veterans in the crypto space and in the space of economics, right? Who will be judging the various submissions or the work done by the panelists. And the topic for the economic hackathon is to see if we can create a new kind of currency that has various properties. It does not have to meet all of these properties, but it can meet some of them. But it can also maybe address some other properties as well. And that is to create sort of like a currency that is value stable, that has stability over time, a currency that is not centralized to a certain party, unlike most fiat currencies we have today, a currency that is as widely can be as widely accepted by many nations, individuals, and so on, and uh, and sort of has features that improve upon the existing fiat currencies that suffer through centralization, inflation, and so on and so forth, right? So it's a very broad question, but at the same time, it is a question that economists have been trying to answer for decades, right? Now, such a complex question is not easily answered by either maybe one person or in just an hour. And that's the purpose of this hackathon, is to bring brilliant minds together, which is what we have here, uh, to come and ideate and brainstorm and take the step forward to creating such a currency, right? It might be the case that we do find an ideal model today. It might be the case that we might not find the ideal model today, but we at least take the step forward in pursuing or finding that model. So with that in place, I think we are good to go. And
Yeah,
uh,
sorry,
yeah,
Steve. I just spoke with Suhas. He's having a bit of trouble dialing in. So let's just try and troubleshoot that super quick, and then we can get going. Do you want to see to that, and I'll speak to the participants a little bit about format?
yeah, sure. So obviously, thank you. Thank you guys for coming. And Harish, yeah, just take it over. And yeah.
Okay. Hi guys. Yeah. Thanks for all attending. And sorry for the slight delay. We're just having a little bit of trouble for Suhas to dial in. But in terms of format, how it's going to roughly work is we're just going to have a short introduction from Steve. That's happened. Suhas will say one or two words about the sort of outputs that we're hoping for, and then we're going to dive into each of your sort of presentations. So you'll all be able to share your screen on your side to present any materials you may or may not have. Each participant we've given roughly 10 minutes to, followed by 5 minutes for more general sort of discussion and any comments from anyone else or the panelists. So at the end, and we're trying to encourage each of the participants to sort of critique one another's lines of thought and reasoning, and then we'll have a sort of 20 to 30 minute window at the end for us to have any further questions and be a bit more free with the discussion if that sounds good.
That sounds like a great summary of how we plan to proceed today.
Okay. And I think also Suhas is in. Suhas, are you there?
Yes, I'm sorry about that. I don't know what happened, but I've managed to get in.
Yeah. Perfect.
Perfect. I think Suhas, you're just in time. We've given a brief about the sort of event, of course, and a little bit about the format. Do you wish to say any words? And then once we're ready, we can dive straight into Heldger's presentation.
Yeah, no, brilliant. So thanks, everyone. Good morning. A happy and blessed Easter Sunday to our Orthodox friends and colleagues. Thank you for making the time. We've had some really good interactions on a one-to-one level. And after each of your presentations, we would love it if the participants, all the academics and so on who are presenting, would also interact with each other as well, so that we can add to our collective wisdom. So that piece would be greatly appreciated too. We've enjoyed our conversations with each of you, but to see you each conversing with each other would be lovely too. So with that, I'll hand back over to you, Harish. Thank you.
And I'm going to pass that straight on to Heldger. We're actually 5 minutes ahead of schedule, which is probably going to be eaten up later at any stage. So, Heldger,
exactly.
Would you like to take over the mantle?
Excellent. Good morning or good afternoon. So we have already one-to-one meeting, and I expressed some concerns about the stable coin. Now, I see this with some concerns because as the cryptocurrencies market goes on, I can see, or at least I suspect, that something like Bitcoin cannot be a currency, and cannot be a currency because it cannot fulfill simultaneously the function of medium of payment and reserve of value. Let me explain what I think about this. So, let's see that in scenario 1, you have a cryptocurrency like Bitcoin, and the value is increasing, let's say linearly. Now, if it is increasing, if it is used as a currency, it will be deflationary. So no one is going to use it today because the value tomorrow will be higher. Now, I don't know if you know this, but Tesla accepts payments in Bitcoins. No one is using it. No one is using it because if they can use Bitcoin today to buy one Tesla, and if they believe in Bitcoin, okay, they will use it tomorrow and buy 2 Teslas. So the other thing is that, so if it is increasing in value, it will be used as reserve of value. If it's not, some point in time, the confidence in Bitcoin will decrease. So, and then it will not be used as a reserve of value or a medium of payment. So if we are thinking about Bitcoin as a currency, that will not happen. Bitcoin is a poor speculative asset. So that's the main point. So I'm not talking about volatility. So you have a problem there also with the short-run volatility. But let's say that the price of Bitcoin is stable in the short run and has a linear positive trend in the long run. So what will happen is that Bitcoin will be used as a reserve of value. The point is that the offer of Bitcoin is capped. It's capped at 21 million units. So the adjustment between supply and demand will be done by prices and not quantities. So that's what's happening here. Now, about a stable coin. For a stable coin to be successful as a medium of payment, it has to be highly liquid. So that means that it has to be a general acceptance from the public. It has to have a short run stable value. And in the long run, it can increase in value, but not so much. So but basically the ideal scenario would be for the stable coin to follow the inflation rate and nothing more. Because if it is more than that, people will see that as an investment, as an investment tool, and as such, they will look at it in the perspective of speculation and not as a way of payment. So you have a paradox here, because you want to, for the stable coin to be with increasing value, the stable coin has to be generally accepted by the public. Otherwise, it will work as a way of payment. Okay, so there is a trade-off between the two things. Now, about the underlying assets, you cannot guarantee for sure, whatever assets you use, that the value will be always increasing. You cannot. It's impossible. Even if you peg the stable coin price to stable assets, such fiat currencies or other things, you cannot for sure guarantee that. I think that you are doing okay with underlying assets. So you have some fiat currencies, you have Bitcoin there, and I can't remember what's going on. But the weights, you should have a mechanic rule to rebalance the portfolio. And you can use the minimum variance portfolio, something like that. You can use portfolio insurance techniques, something like that, but it has to be mechanic. So let's say you have to update the weights periodically, let's say quarterly, and you have to have a formula to update those weights. Another thing is the way that you have to deal with speculative attacks. So you have to have a reserve fund to tackle those attacks. So you have to part of the issued stable coins covered in order to address those attacks. It can happen. So if let's say a hedge fund put some attention on your stable coin, you have to have some capital on it to tackle the attacks of the hedge fund. So these are my main ideas about the stable coin. So if you look about the most successful stable coin, let's say Tether, I don't know how you spell it, Tether or Tether, something like that. If you look at it, so the main thing is that they guarantee a parity with the US dollar. Okay. Sometimes in the short run, it doesn't happen. Now, it's most successful. Why? Because people are using it to enter into the cryptocurrency world. So let's say they transform fiat money into Tether, then Tether allows them to buy Bitcoins, let's say, and the registration of transaction is lost when they buy the Tether. So that's why it's successful. Now, there is another concern, is that they say that the value of Tether is covered, and the United States regulators are putting some doubts on it. So there are some regulatory issues going on here also. So that's my main point. So now, create a stable coin that has positive, slightly positive trend. It should be pegged to the inflation rate, nothing more than that. Okay. Yeah. So there is a Tether. Yeah, no, that's it. There is something in the chat. It's Tether. Yeah. So you have to have a stable coin that the value on the long run follow the inflation rate. In the short run, should be stable. Okay. And you have to make people believe that is in fact a stable coin, and you are dealing with the issues such inflation. Okay. So you have to convince people about it. And there is the other point about the underlying portfolio, the way that weights should be computed. mechanically, and the way that you should cover the price of your stable coin. So you have to put some capital on it and hope for the better. So these are my main ideas. Okay, thank you.
Perfect. Harish, can you take over?
Yeah, I'd like to just open that the few points that that Heldger made open to the other academics to see. This is the first time they've probably heard some of Heldger's inputs. So if they have any comments or any discussion points.
Yeah, I have a question actually, or just a question would say. I really found your idea on Bitcoin quite interesting, that the transaction volume, or that's the problem, that if prices increase, or if transaction volume increases, prices increase, and this then harms its its use as medium of exchange. And I just want to ask if you have tested that somehow, because it should be possible. You can maybe check the transaction volume on Lightning, which is more used for really like peer-to-peer transactions and paying goods. And just the prices. Is there some correlation? Have you looked into that?
If there is a correlation between what, Ingolf?
The transaction volume on Lightning, on the overlay, this second layer network on Bitcoin, which is
well, if you look at the transaction volume of Bitcoin, and in the long run, and the price of Bitcoin. So if you use, let's say, monthly data, they are highly correlated.
Mm-hmm.
But in the short run, sometimes there is selling pressure. It happened 1 week ago, and you have high volumes and decreasing prices. So the main point here is that in the long run, let's see, people believe that the price of Bitcoin goes up. Okay, people are saying that in 2024, one Bitcoin will value $1 million. Now, if you have some Bitcoins, why should you use it today to make your payments? You're not going to use it today. You will preserve it until 2024. Then, if you continue to believe in Bitcoin, you think, well, I can buy 2 Teslas. No, I'm just going to buy an island in Seychelles. Okay, so you are not going to spend it. That's the main point. That's what happened.
I see. Yeah, no, it's interesting. I just wondered, like, if you can somehow, or if one can somehow test that empirically, because it's a very interesting point, and I think it relates very closely to a model like of Van Oort and Bolt. They model like the prices of cryptocurrencies also like with a supply that is just like frozen in order to speculate, which is.
I'm just these are so preliminary ideas. I'm just beginning writing a working paper on it. So on the impossibility of a cryptocurrency that has a capped supply to be the two things. You can have a theoretical paper on it. So you have a competing fiat currency that is stable in value, okay? And in the other end, in the other side, you have Bitcoin with these features, okay? It's like the Gresham law, the bad currency expels the good one. So that's what's going to happen. This is not a new problem. So the most, let's say, in this perspective, the bad currency will be the fiat money. It will expel the Bitcoin. So that's, well, I think that we can have a theoretical paper on it, and you can have also an empirical one testing what I'm saying. So yeah.
Interesting, cool. And I have another question actually, but that's related to the stablecoin now. So you mentioned the possibility of attacks on the peg for this like part, and I wonder, so if the idea is to collateralize it like for 100%, then I wonder if it's really possible to attack it. So you could like mint just new coins and then like throw in the market. But on the other hand, you can just like absorb them and put the collateral back. So I think as long the coin is collateralized 100%, this shouldn't be a problem. As soon as you like change that to a fraction, then you have a big problem. I think it has been shown in the history that it can't be done. It's like
That's the point. Yeah, precisely, Ingolf. So if your collateralization is low, you have a higher risk there. That's what I'm saying. So you have to put some capital into it, and you have to maintain the value. If there are some selling pressure or buying pressure, you have to enter into the market, okay, and your capital will be at risk. But otherwise, you cannot maintain the stable value. It's impossible, simply impossible. So that's what I was saying. Yeah,
I agree.
That's right.
Perfect.
Can I just?
Yeah, go ahead, Darko.
Yes, Ingolf asked in the beginning. I would like also to answer on this, connecting to their stories for the methodology. It's actually it's very easy to measure market reaction. So if you have decrease, for example, and analyst recommended the negative event in one day, everybody will make higher volatility and the sell. And in the case of the positive, mostly is delayed more than 1 or 2 or 7 days because they are not scared for this. So there are two kind of approach for the measurement, including the cryptocurrency. And this one also, one is the event window models approach, where you can, according to events, explore and econometrically express what will be the reaction after the analyst recommendation. And the second one is the different kind of the portfolio approach that it's possible to measure. So it's very easy to measure, and it will be good idea that you mentioned to include also for the Maha currency to see how the market react according to this measurement. But we have to wait. It's a very short period of time of existence. After maybe 1 year, it will be possible to collect enough data and econometrically to test or to collect in the portfolio to see market reaction.
Do you mean about this stable coin, this precise stable coin?
Yeah. They are also react on this, of course.
But I think that the liquidity is quite low. I don't know what is the number of traders involved in the market. So if you gather data for 1 year, it will not represent the stable coin if the number of traders increase significantly. That's my main point. So yeah, your idea is quite good. But you see, Darko, if you have just say, well, 100 traders, okay, and so they have market power there, and you look at the data, you have some kind of dynamics. Now, you want the stable coin to be more liquid and more people to transact it. Once it happens, there will be a structural breakdown, and things will be different. So well, you can always use the data to get some feeling about what's going on, but I'm afraid that will not be representative of another state of maturity of the stablecoin. So yeah, we can use it. Yeah, sure.
Okay, thank you. If you don't mind, this idea also I will, from my point of view, I will present in my part and to not take too much time now in this moment from others.
I have a quick question for Heldger. I was thinking about the interesting point that you made, which is interesting as a philosophical point to me, apart from the empirical side of it, of course, that essentially, because something is a great reserve of value, it discourages its actual use. Right? That was one of the main takeaways from what you said. And I was just comparing, I was thinking of it from a historical perspective. Now, history also provides empirical examples. In the late 19th century in Europe and worldwide, because of agricultural changes in productivity, etc., we went through a period of extreme deflation, especially agricultural deflation. Post the American Civil War, 1870s, 80s, 90s, new territories were discovered, so the price of food kept falling, etc., etc. In that period, gold was a tremendous reserve of value. That's why we basically had a global, gold standard in most countries. Maybe India and China were also on silver, bimetallic, whatever. So, but nevertheless, people did sell gold in order to buy goods and services because they couldn't eat the gold. So consumption can't be deferred indefinitely. So my question to you is, even in the case of Bitcoin, Bitcoin has steadily appreciated over the last decade. But there are not just purchases, there are also sales of it. People do sell Bitcoin, otherwise we wouldn't have a two-sided market, right? And those people are booking profits and maybe using it to buy something that they want, because the Bitcoin itself can't satisfy those fundamental needs, as an economist puts it, right? It doesn't feed you or clothe you or provide shelter or anything like that. So I just have a question. How does that sort of affect that sort of point about the reserve of value? I get your point that it may not become a currency, but the reserve of value will still be sold to purchase things, right? Even if it means not directly being used as a currency, but being exchanged for currencies, which is what currently happens. We exchange it for fiat or USDT or whatever it is to actually buy things. So that's my question.
Well, people used gold at that time because they didn't have any other value currency. So if they have gold to spend it, they will spend it. Now, you have Bitcoin and you have fiat money. And you have the two things that you can use to make transactions. So it's just not a problem. I have gold and I have nothing else. So, and I have to buy some food, I have to use gold. Now, people don't have just Bitcoin. People have Bitcoins and US dollars and euros. Now, from the rational point of view, what should you use in an exchange? I'm not going to use Bitcoin. We are going to use other fiat money. So it's quite different, the two scenarios. Now, yeah, you say that it's a two-side market. Of course it is. But people are using Bitcoin to invest. The use of Bitcoin to buy assets and to buy other things in the economy is completely marginal. It's completely marginal. And the transactions of Bitcoin are done within online exchanges. They are not passing through blockchain. So what people argue, what is Bitcoin, in fact, is not happening. So Bitcoin is traded like a speculative asset, okay, inside online exchanges. They are not validated by the blockchain. It's not, they are not used in bilateral exchanges, okay. So the price is resolved in a multilateral negotiation, as in, let's say, the stock exchange. So if you look at it, it has all the features of a speculative asset, and even more because we don't know its fundamental value. So my main point, yeah, well, you see, what I'm saying is that you can have deflation from different sources. Now, Bitcoin was created to be deflationary. So the adjustment between supply and demand will be done by prices. Of course, there is short-run volatility. Now, if you look at the Bitcoin price, you will see some bubble periods, bubble-like behavior of prices. I do not say that those bubbles are unrational. They can be rational. See, there is a expectations game going on. It's as follows. I will buy Bitcoin today because I believe that someone in the future will act as myself and will buy Bitcoin from me. So if this continues like this, and it's only about confidence and expectations. So if you have this game going on, And if more people enter into the market because they believe in Bitcoin, you'll have an explosive price bid. That's what happened with, with Elon Musk entering into Bitcoin. So he is an opinion maker.
Heldger, can you conclude so that we can go to the next panelist?
So that's my main point. So there are quite some differences.
Yeah.
So
thanks, Heldger. Sorry, Steve.
Yeah, no, so that was fantastic. I mean, this is the first panelist, and there's so much insights coming about. I mean, it's absolutely amazing. But yeah, obviously now let's take on to the next panelist, Harish. If you can take it over, that'd be great.
Yeah. So we'd like to invite Ingolf, but yeah, Heldger brought up some very interesting points. I think one thing that I'm quite curious of is how both sort of crypto and fiat are going to coexist. I think earlier this week, in fact, Revolut enabled Bitcoin withdrawals for some of its users. But Ingolf, would you like to perfect. Thank you. Checking everyone can see his screen.
Can you see my screen? Oh, can't.
Yeah, we can.
Yeah, perfect.
Cool. Yeah, I made a small presentation. I tried to be quick. So first of all, I started to condense your questions a little bit because you had these two big question packs and also questions for the discussion. And I grouped them around Maha, so the token of the system, and then Arth. Obviously these two question packs, I condensed it a little bit. So for this question of Professor Zoran, I condensed that to how you would optimally guard the stable purchasing power. And the question of Suhas I would group into or condense into something like, assuming stable purchasing power, how would you ensure demand and fluctuation? And I thought that at this stage, actually, it might sense to start with Suha's question because it's sort of the business side of the thing, and there's so much competition going on in the stablecoin market right now, so that this is like a nice starting point. In human terms, this question implies, so first, why should I hold Arth in the first place? And second, assuming I have it already, why should I use it to buy my coffee? And I think it's actually, it sounds easy, but these questions are really non-trivial. And I tried to tackle them and go a little bit deeper into them by using the 3 motives for money demand by Keynes, which work quite nicely with stablecoins actually. So demand for transactions, a precautionary demand, and speculative demand. For Arth, this means that first, you may want to make sure that Arth is the better garant of making use of investment opportunities. Second, that it's the better medium of exchange. And third, it's the better store of value. So let's start with the first one, Arth, the better garant of making use of investment opportunities. This is actually something that, as we see already with Tether and all these other very professional coins that are just used as switching in and out the altcoin market to be quicker there, cheaper there. And this market seems to me very satiated. And I don't see that that's really a selling point, so we can go on. But I think that's not the right way to enter the market. Second, Arth as the better medium of exchange. And I would use the two-sided market model of Rochette and Tirole here that they had for sort of network effect, markets with network effects. And this model was also used by Bolton van Oort for virtual currencies. And I don't have time, I guess, for the equation. It's also quite simple. But lastly, the idea is just that merchants need the consumers already on board in the network, and the consumers need the merchants already on board on the network. And this is like an hand and egg problem, which you somehow have to solve. And this means for Arth that you would want to make as many collaborations as you could. So with messengers, credit card companies, fintech, social media platforms, the stores, of course, maybe smart contracts, but also they are very satiated already, maybe for new platforms. However, the problem here is a little bit that I think that at your stage, you're pretty young, and there are 2 players or 3 players which are much farther there. So Silo and Stellar took over already some messengers. For example, Stellar will collaborate with Signal. Diem or Libra will collaborate with WhatsApp, or they are WhatsApp basically. And in general, Silo, I think you can learn a lot from them. They are very, very strong in building collaborations, and you see that they are focusing on that a lot. And the other thing is that if you're not big already, it's very hard to make merchants talk with you. So I would see this only happening if ARF is already like in the hands of many as store of value. This brings us to the third demand motive, and that's ARF as the better store of value. And here as well, I see some problems arising, because for normal times, it's really hard to convince people not just to read credit money or cash or like digital cash. Central banks are also like innovating. Also in this branch of stablecoins, there are already stablecoins that do that. CELO, for example, they're pegged to all kinds of fiat currencies. If you get a little bit more like aware of risk, you would maybe like a currency basket or gold-pegged stablecoins, but also there we have some already. So Globecoin is pegging to a currency basket and gold, very similar as what you would like to do. Libra, of course, currency basket, and Tether Gold, the other current stablecoins pegged to gold. So there's some space already taken. So I don't see how it would be easy to get the foot into the door there. And of course, if you're very like paranoid, you could just go and you would also compete with traditional safe haven assets like gold, silver, all that stuff. I see, however, somehow that you might like get in somewhere in between, because all these like either these stable coins are just as hedge for these like Tether Gold or something, so the digitized form of gold, but then they are more volatile as gold, and none of them really is trying to do the same thing like Bitcoin, for example, where they try to be very resilient against the government access. They very like try to be anonymous and stuff like that. And so I see maybe you could do something like a narrative on ARF as the stablecoin that endures Black Swan days. And also in our 101s, I felt that out somehow, that you are interested in that. The problem here is, of course, still that it's, of course, a very long way to credibility and track record. And also, you have still this problem of how really to ensure stability. So as a like small summary or like intermediate step, I think the precautionary demand is the way how you get the foot into the door. Now, how you could do that, I'm not sure how much time I have for the details. You could do it, of course, centralized. Okay.
Go ahead, you have time, yeah.
You could do it, of course, in a centralized way as you propose it, more or less. So you just form a portfolio, you try to make that as stable as possible, also in times of Black Swan events, and then just tokenize it as like Tether does with just dollar, and then like hedge the dollars onto some blockchain solution and make it travel the world. Yeah, this would be one solution. The financial risk that you mentioned there, like to forecast unexpected shocks, I think is really, by definition, not really, it's hard and expensive. So you would need to beat people like BlackRock, Goldman Sachs, and that will be hard and very expensive. Probably something like Heldger already mentioned would be better, some rolling over hedges against volatility. I'm like no professional in this space, but you could do something like straddle or strangle option strategies, how you hedge just against the volatility in short term and not against everything, because this will also be expensive. But on the other hand, you can just like cover it with fees then. This from the financial risk aspect. Regulatory risk you could tackle in the same way like Tether does. So just put up your headquarters and treasury in some jurisdiction outside of Europe probably and outside of the US, and make the tokens travel the world. But one very important risk I think you have not on the list, that is the counterparty risk. I think people are very aware of that, because then you're a company basically, and we see that for Tether as well. They have not so much credibility. People just don't trust them because like people in the crypto space are paranoid anyway already, but with companies they're much like more skeptical already. You could try to like somehow mitigate that with like some blockchain solution, permissioned writing, unpermissioned reading and stuff like that, or also like conventional governance structures, but it's still like just a communication issue, I guess. And how to make sure that you can't run away with money. That's really like the biggest problem of many stablecoins that do something with like real assets. And you could learn something from Nubits in respect to governance, because they are like, it's a very interesting case, because there you have all these, they had a very complex governance and the people were able to run away with money. And it's like a very nice drama that is kept like digitally. Then if you would be centralized, there are some other things that you could do. First of all, you have to somehow take care of GlobeCoin because it's the same thing, and they are much farther already. So they have already like Visa cards that you could use to pay and stuff with their coin. They also like have collaborations with, so they have a two-edged strategy somehow. Yeah, just like took a look into it. Collaborate, of course, which is hard, but of course one part that I find always very important, like to be transparent. So monitor risk like ongoingly, not only like in some white papers, but make risk indicators that show when like the stablecoin is like in danger and like show what the problem is really. I think this helps to a certain degree. So disclosure, you would say, for businesses. But also have very like strong white papers showing where the problems are, and like with respect to many threat models, so economic threats, regulatory threats. Also like take care of these things like de-anonymization. It's also like for these stable coins, nobody talks about that. For normal cryptocurrencies, everybody talks about that. Trust is a big, like maybe the biggest issue. So you somehow need to bootstrap that, that people can trust you. You need to have like leading figures, maybe academics, of course, also like professionals from funds that like people know, and that can be a like window dresser. And maybe the most important thing is that you have to somehow activate the community. So Zelo or DAI have very, very strong community around themselves, and people just like them. And that makes a huge difference because then they have collaborations, people work with them, people develop things around them. Also, they buy their tokens, right? They buy the equity tokens, they buy their stable coins. This helps. Yeah, and maybe one like outside the box thing that I had here in mind. The thing is that actually to this narrative of a stable coin that induces black swan days, or like a stable cryptocurrency in any days, maybe it's actually much better to do it decentralized and don't do it with like real assets, but just do something like a synthetic peg. So create a pack, a basket of goods that for like any specific, I don't know, maybe country or continent, and just pack or synthetically pack your currency to, I don't know, 1 liter of gasoline, 1 liter of flour, and 1 liter of sugar or something like that people can relate to, and then do it like DAI with increasing arbitrage around that. Of course, also DAI has problems, so they have issues with liquidity. There were like the attacks that were possible. Gervais et al. Was a very interesting paper, 2020. I'm very fond of full collateralization. So as Heldger also already said, like if you have limited reserves and not a full collateralization, then like basically a living corpse, I would say. At least if you look at history. So these kinds of packs were like very, very often attacked. I think it's about 80% or something I have in mind, that of historical packs that were not fully collateralized that broke. And one last thing, oracles are of course always a weak point. So you have to somehow get price data into the chain, and also transparent on that is just increasing sort of how people view you, I guess. Yeah, this was much longer than I expected, or you expected, maybe. I hope it's okay. Concluding, just I think it's like maybe a good first step is to focus more on the store of value and precautionary money demand. You have to somehow sell from GlobeCoin. There's very tough competition, and it's very hard to build a stablecoin right now, I guess. But maybe you can lock into this narrative of like inflation crisis things. Schiller, with his narrative economics, is very nice, like sort of guideline there, I guess. That's also very nice read, just. And really don't forget community and how the community views you. And I think a centralized solution is very like, people in the space don't like that so much, to be frank. Yeah, and that's also like the last thing. So rethink this portfolio approach and try to think about maybe something like a synthetic peg like DAI. So thank you.
Awesome. Can we just take one question and then conclude with Ingolf? Yeah, and this is fantastic, by the way. This is an incredible take Ingolf. So really, thank you for such an impressive presentation.
Sure. It was fun, actually. Thanks.
So does anyone have any question to ask Ingolf? We can just take one and then probably move on. Yeah. Suhas, are you there?
Yeah, I just wanted to just see if anyone, Ingolf and also Heldger, really thought-provoking stuff. Thank you very much. Ingolf, on credibility is a very important thing. I loved your description of window dressing. It's very sad when economists have to also window dress, but we are market oriented, so it is what it is. Have you thought about what kind of things in terms of signaling that could be intangible, that could add to governance and build credibility over a period of time? Because when we think about collateralizing and stuff, it's like Back to the Future. There's a reason why things left the gold standard. And anything that chokes supply as a way of maintaining its value is a bit like us saying that, cutting down trees hurts, it causes global warming, so let's move back into caves.
Yeah, I'm not sure if I have a perfect solution there. In terms of signaling, I think it's really like transparency is maybe my favorite part there. So I think that if you show that you have nothing to hide, then this is already a very good sign. If you show that you also know your weaknesses, because also in this space, it's really not that usual that you show your weak sides, I guess. And many stablecoins just do a lot of marketing, basically. Yeah, I guess that would be it, I guess. But at least off the top of my head.
On the transparency, what you're saying is, even when things go wrong, if market participants, the parts of the community that form the economy, understand that you're clear and open with it, then you can still maintain trust because they believe that what you're saying at any point in time is accurate.
I would think so. I think it's better than to hide it, because in this, maybe you can sort of open it up strategically, but in the long run, these things will come out. So I think again, this new bits is very, very, very interesting study case, because they tried things, there were things going wrong, then they had some committee covering up things, and had the peg breaking and then recovering, and they said invented stories how to why this happened and stuff. I think just covering up is not it will come out at some point, and then it's the death of the project, more or less. Because also with these stablecoins, I think once you really it's very easy to lose trust, because it's not like a company stock that goes up and down, but you promise just flat. You have 100% promise that is fixed, and one deviation of it already is sort of counterproof.
Yeah. And this is a discussion, I think, eventually Suhas has mentioned that where governance can possibly, play a role in protecting or providing transparency or decentralizing the authority behind a stablecoin. So on that note, I think, we have to thank Ingolf for his time. And Ingolf, this is fantastic. Hearing from you and hearing these ideas, and especially these case studies that you have sort of pinpointed also. So thank you for your time. And obviously now, Harish, can we move on to the next participant? Yeah.
Sure. Yeah. Thanks, Ingolf. Fantastic stuff. Can we move on to Nikola, please?
Yes, of course. I prepared a short presentation just to put on the screen.
Yeah.
It seems that there are some difficulties with putting my PowerPoint presentation.
Harish, you'll need to authorize him so he can share screen.
Maybe I'm not authorized, I don't know, but it's not functioning.
Can you, if it's like a normal Yeah, it's like a normal Zoom screen share.
Just to try once more.
Yeah.
I apologize, but it's not possible. So I will speak without my presentation.
Yeah, sure.
I can later
No
send you by an email presentation.
issues.
I'm glad that I have opportunity to participate on this conference and that we have a possibility to exchange our ideas and views. I think that the essence is a message of Fed President Jerome Powell, who recently announced that the cryptocurrencies are very unstable and that valuable stocks are not useful. He stated that it is a speculative property that is more suitable for gold than for dollar. Actually, I think that the problem with the cryptocurrencies is that they have too high level of fluctuation, especially in the short period of time. Actually, they have more characteristic of speculative securities than characteristics of money, and they are currently attractive only for speculative investors, and they are not very attractive for normal investor and for general publics. If we have in mind the current situation, it's obviously that the central banks will continue with the quantitative easing policies and that there will be strong expansion in the money in the coming period. But I do not believe that fiat money will lose credibility because up to now we do not have any good alternatives. Great inventions are always connected with the crisis, and the global financial crisis, and one of the inventions of the global financial crisis was the cryptocurrencies. Cryptocurrencies are real, cryptocurrencies are subject of the trade, but today we have more than 1,000 cryptocurrencies, and it is very difficult to reach credibility, and there are a strong competition between different cryptocurrencies. Regarding my further presentation, I will focus on 5 specific points. How can I see possibilities to improve your global measurement unit in order to gradually reach and increase credibility, because I think that the key word is credibility. My first point is that it is very important to have a relatively stable value with a predictable trend. This means that there should be no cryptocurrencies in the basket. So I think that you need to correct our basket in order to reduce fluctuation, especially those that are subject of asset bubbles in any market. First of all, I don't think that there should be Bitcoin in the basket at all, because it has huge fluctuations, and at the moment, it's obviously a classical example of asset bubbles. And my expectation is that due to large speculative investment in the previous period, we should expect some drop of the Bitcoin value in the future whenever we have decreased the level of the certainty on the global markets. Now, these days, we have some, we are witnessing of some certain corrections of the value of Bitcoins. On the other hand, Bitcoin is your competition, and the inclusion of the Bitcoin in the global measurement unit send a message that it is in some way more important or more valuable than art like your older brother. My second point is that in order for a basket to really represent a global measurement unit, I think that the basket should consist of 3 parts. By omitting any of these 3 elements, I think that it would be difficult to talk about global measurement unit, but of course, we can still talk about good basis for determining the value of the art. I think that the first part of the basket should definitely consist of currencies as it is currently in the basket. It is further possible to consider expanding the currency basket with some new currencies in order to reduce fluctuations with, for example, Australian dollar, South African rand, and possibly some other currencies. I think that it will be good to see the decreasing the weights of existing currencies, especially the part of US dollar, because if you have too high weight of any element of your basket, then then the value of art will dominantly depend on the value of that element. The second part of the basket should refer to products that have a significant share in international trade. Gold should certainly remain in this part, but due to high volatility of the price of gold, I would certainly suggest a reduction in its weight. The basket should be supplemented with some additional products whose prices are listed on stock exchange. Certainly, the first association of all of us will be connected to oil, but we should be very careful with it because it has a large degree of price fluctuation of the oil. Maybe the compromise could be that will be in the basket with a relatively small weight. The third part of the basket should represent the value of globally important companies. Such an idea has already been hinted in the material that was forwarded to us with the proposal to include the stock exchange index S&P 500. I think that it is an excellent proposal, and my addition would go in the direction of considering the inclusion of additional indexes representing the value of at least European and Japanese companies. With this structure of the basket, currencies, products, and stock exchange indexes as a representation of value of companies, you will have better representation of global measurement unit on one side, and on other side, you will decrease the weights of each individual element, and you will minimize the possibility that your global measurement unit will be under strong pressure of speculative investment or asset bubbles in any element. My third point is that it is necessary to periodically review the basket in order to change the weight in accordance with the changes in the participation of individual countries in the world market or individual currencies in international trade and global reserve. Because, for example, the share of dollars in international trade and foreign exchange reserve is decreasing. The change in weight should be based on certain rules that will be publicly known in advance in order to preserve credibility. It is very important, at least in the beginning, until sufficient credibility will be gained to avoid any discretionary decisions that could produce any doubt among investors. My fourth point is connected with the fact that there are a lot of asset bubbles and a lot of speculative movements in any different products that could be or is in your basket. I will suggest to introduce some kind of a rule that will limit maximum possible monthly or daily fluctuation of each element of your basket. Of course, it's not anything specifically new. In any stock exchange, you have rules that are limiting the possible daily fluctuation. Of course, there are many possibilities in which way you can limit the fluctuations. And my last point regarding the improvement of the art currency is something that is already mentioned by the Heldger, and it is that it should be very important, if it is of course possible, to provide some collateral in fiat currencies, gold or securities. It will be very important in order to have credibility, especially in the beginning, because the individual will ask, today I have more than 1,000 cryptocurrencies. The art is one of relatively new, one of one that is appear on the market after we already have 1,000? What it is new that the art will provide for us? So I think that this collateral will be also good against any potential speculative investment. My opinion is that it is necessary to adjust the basket in order to reduce the fluctuation and to increase credibility. If I'm investor, I will prefer the asset that will have stable and predictable value in the long run with slight growth tendency. All the big fluctuations in either directions can only stimulate speculators, and I don't think that it should be the goal. So finally, my conclusion is that it is necessary to exclude cryptocurrencies from the basket, to change the structure of the basket, to make periodic changes in the weights, to limit maximum allowed fluctuations, and to consider possibility to provide some collateral. Thank you.
Thank you. Thank you very much, Nikola, for outlining some of those risks. Does anybody have any comments?
Yeah, I do have a question. So, Nikola, you mentioned the proposal for having oil as one of the components in this basket. So oil has, of course, gone through a black swan event recently because of the COVID, right? So would that be an advisable asset to include, or and what would be some of the parameters you would you would try to evaluate when assessing the risk of such assets, right?
Black swan is always possible. We have black swan in the past, and it will not be normally to expect that they will not appear in the future. But generally, my idea is that you have, let's say, a high number of elements in the basket. So if you have high elements in the basket, then each individual element will have small weights. Whenever you have small weights of any individual elements, then there are no possibility that it will be too high influence of that individual element. If you look current structure, then you have only 8 currencies. You have gold, 8 currencies, gold, and the Bitcoin. I think that the such structure is more risky. But if I correctly understand, the idea is to have a global measurement unit. And it's normally that over the time, the global measurement unit will go up or will go down. And when there are some high unexpected, let's say, fluctuations or deep recession, it's normally that if you want to have global measurement unit, that the global measurement unit will go down as the level of production, GDP, employment, investment will go down in such circumstances.
Got it. Thank you.
Nikola, sorry, I know we're running a little bit behind, but I really appreciate it. Very interesting. In terms of thinking of what is included in the basket, you mentioned about the volatility of crypto being a speculative asset and then having, say, more fiat. Now, if we think today, I was interested in there was no explicit mention of the real economy. If we think today, a lot of the fiat currencies or valuation of anything is actually underpinned by the scale and persistence of quantitative easing. So in some ways, aren't everything speculative, whether it's Bitcoin or currency values? And if you were to design a basket using speculative assets, would you think about correlating it more to the ability and willingness to be able to print money to support that particular asset by central banks as being the metric rather than anything else? So, for example, if we believe that, take the euro area, trade surplus, broadly speaking, the euro has a fiscal conservatism in it, that it's able to print money longer, and therefore you would put that into its you might overweight that. Would that be a way of thinking about it, or could that be a way?
Fiat money is existing. The fiat money will exist. The fiat money have credibility. The fiat money will have credibility in the future. And I do not think despite the fact that there will be quantitative easing, despite the fact that there will be the losing purchase power of money, that it will be possibly to avoid fiat money.
Thank you.
Great. Thank you so much, Nikolai, for your time and for your presentation. And it was really interesting. And I think we should definitely now go to the next participant. Yeah.
Yeah. So I think we've had the first three. So the fourth is Moinak. If Moinak can take over.
Hi. Hello again. Can you hear me?
Yep.
Yeah.
So can I share one document? So just give me a moment. Is it visible to you, all of you?
Yep. Yes.
Okay. Okay. So before suggesting anything, so maybe I thought like to look into the performance of the Maha as a cryptocurrency. So I took some data that is already trading. So I took it from December 2020 and to April 2021. So first I try to understand that whether this existing model is quite stable or not. So for that, I took the daily returns of this Maha cryptocurrency. And first I test for whether the return series is giving any linear pattern or a non-linear pattern. So I try to understand that. So in that regard, I found that this cryptocurrency is a bit non-linear. So the nature of the return that it is showing over the period it is trading from December to April, it is showing very high non-linearity. So you can see this probability value which are quite significant. And next, try to understand how stable in terms of volatility clustering. So I just run a simple arch model. So it shows that actually this return series does not have any volatility clustering. So which means that even though this return shows some kind of non-linearity, so maybe it have some structural breaks or maybe regime switching, but still there is an absence of quite of this volatility clustering. So in that term, just before going into the evaluation, I think that this the existing that model with that three currencies that they are generating, I think it is quite okay. So now the next part. So I think when we have a discussion from one to one, so we try to understand that this is a digital currency. So how the cyber attacks can affect the performance of the model or the stability of this particular currency. So on that part, I just maybe I didn't spend much of time, but whatever I got. So from that, I found that it really these cyber attacks are really responsible for the spillover or maybe the contagion effect among the cryptocurrencies. So how they're related? So maybe the study shows that suppose there is a one attack in one day, then in such case there is a downward shift. So downward shift means, so with respect to Bitcoin, if there are other coins like your Litecoin or maybe other coins, so in such case that currencies have a negative contagion effect. So if there is a one cyber attack in a single day, so the return series got affected. So which means there is a instability in that part. But when you are including Bitcoin, so as in case of this MahaDAO Earth, so there is a 5% weightage given to the Bitcoin. So that when the cyber attack is coming on, so at that time people are holding the Bitcoin. So as a result, that whatever this recursion effect that is coming from the cyber effect, it is not actually affecting the overall stability if you are considering other cryptocurrencies. So in such case, in your model, you are only selecting Bitcoin. So in such case, if there is a cyber effect, cyber attack, so if there is a one single attack in a day, so probably it is going to downward shift the other cryptocurrencies. So there will be a spillover effect or maybe a contagion effect. But if you are holding a Bitcoin, so in such case, it will the investors will have a hold decision. Now the question is, if there is more than one attack in a one particular day, so whether it is affecting the cryptocurrency performance or not. So in case of a second attack in the same day, so it is not affecting much. So the same kind of this performance as seen in case of the other cryptocurrencies. But when the number of attacks are 3 to 4 in a single day, so then there is a large shift in the returns of your cryptocurrencies. But if you are considering Bitcoin, so Bitcoin is quite stable with this because at that time, the investors are holding the Bitcoin. So rather than selling, so they are holding the Bitcoin. So when there is a cyber attack. So now if there is any more attack, so even more than 5 cyber attacks in a single day, so the shift is not large as compared to this 3 to 4 attacks. So if in a single day you have a more than 5 cyber attacks, so probably, and if you have a Bitcoin in your portfolio, so probably it is not going to distort your model as much as if you consider Ethereum or other cryptocurrencies. So now let's look into the structure of the earth. So we have 80% fiat currencies, and we have this 15% gold and 5% Bitcoin. So maybe let's start with this 80% fiat currencies. So as of now, it is including USD, then Euro, Chinese Yuan, then we have Japanese Yen, then INR, we have GBP, then Russian rubles, Canadian dollar, and Swiss francs. So my suggestion is that to remove especially rubles. So instead of rubles, it is my suggestion to bring Kuwaiti dinar. So this is the most strongest currencies that is traded in the world, and it is also very much stable currency. It is considered to be the most stable currency. So I find it it is missing in the basket. So my suggestion is to remove Russia from this particular currency basket and to include Kuwaiti dinar. And I think some presenter was talking about oil. So you know this Kuwait is, I think they are 80% product from the oils they are coming. But still, even during that, when that futures returns of the oil become negative, so at that time also Kuwait dinar was quite stable. So on that part also, so it is my suggestion to bring this Kuwaiti dinar, and I think this is the most powerful and most stable currency. And the next one, so it is my suggestion to remove Indian rupees, and instead of it is to bring the Singapore dollar, because again Singapore dollar is very powerful and again very strong currency, especially in Asian part. So on that regard, I think Singapore dollar is a more suitable substitute in your currency basket. Now come on to the gold. So definitely when you are thinking about some stable currencies or stable coins, so you cannot think anything beyond gold. So I think definitely you cannot remove gold. And I think the weightage that is given to gold is quite fine. So that is 15%. And about Bitcoin, so I think this 5% is okay, because if there is a cyber attack, so as you are modeling for a digital currency, so in such case, I think Bitcoin is the best choice. So I think maybe some of you will argue that it is a volatile currency, but still many researchers shows that Bitcoin is quite stable as compared to the fix, or maybe as compared to S&P 500 index. So this is from my part. So this is what I can suggest, and definitely. So about this portfolio weight, so you can actually run some portfolio optimization. So instead of giving 80% weight, so you can run a program and you can decide that how much weight can be given. But anyhow, in this currency basket, you have around 8 or 9 currencies. So I think 80% weight is justified. So, and I think gold 15% is fine, and Bitcoin is also 5%. I guess.
Awesome. Great. Thank you, Moinak, for that presentation. Does anyone have questions to ask Moinak?
Yeah, I would have a question actually. Oh, sorry. Go ahead.
Yeah.
Okay.
Go ahead. Ingolf.
Me? Okay. Thank you.
The thing is that if you have a global measure, this is just an idea. If you have a global measure, and if it tracks the worldwide economy, will not your currency be subjected to the downs and ups of the world-wide economy? So that's a problem that we have to think. The other thing is that if you have a lot of fiat currencies, you are not hedging against inflation risk. Now, Nikola said one very interesting thing. Said, well, we have experiencing expansive monetary policy. And he says, I completely agree with, there is no other way. So we have crisis now. If there was no quantitative easing, if there was no expansive monetary policy, those crises would have public proportions. We will pay it, but it will be paid in the future in slices. So we are smoothing what we have to pay. So this discourse that we are going against the governments and things like, it doesn't work. It doesn't work. It doesn't pass. So we have to be very careful about this. And so basically for Moinak, I have two questions. So if we are using a global measure, aren't we going to be subjected to worldwide volatility? But that's what we don't want. And the second one is, if we put a lot of fiat currencies, we are not hedging against inflation risk. So just two questions. Okay.
Maybe that is a problem, but I think by including these currencies, maybe a greater part of your this inflation can be captured through these currencies. So this could be the possible justification, what I can say.
Maybe just if I can add, I completely agree with Heldger that currently, instead to paying a price in 1 year, we are now will pay, instead to pay a high price in 1 year, we will pay, let's say, smaller prices in many years in the future. But it will definitely means that the fiat money will lose part of its purchase power, but it will not means that the fiat money will have other alternative, at least in the near future, because there are no good alternatives. So I think that we should keep the fiat money, that we should not limit to small a number of fiat currencies, and I think that you should done a careful analysis and to consider what other fiat currencies will be suitable for including in the basket, because whenever you have more fiat currencies, then each fiat currencies will have a lower weight, and lower weight will mean that it will be a lower level of dependency of individual currencies.
Okay.
Okay, perfect. We can take Ingolf's question and then go to the next panelist. Yeah.
Yeah, thank you. Thank you. I think I was really I like that somebody also did some empirical tests here. However, so I asked myself, so these currencies that you wanted to exchange, you on which criteria did you select them? So probably the stability against the US dollar, right? So the Kuwait dinar priced in US dollar is quite stable. Is
yes,
this the reason?
And Singaporean dollar, yes.
Okay, because then I wonder, the problem is if you live in the US dollar and the things are priced in US dollar, that's fine. But if you pay not in US dollar, then you still can have a problem, right? So this is.
But I think this Kuwait dinar is quite used because 80% of the petroleum products are coming from Kuwait. So in that way, you are paying through this Kuwait dinar. So in such a way, I think it is tradable. And on the other hand, Singaporean dollar is also quite exchanged in the world market. So on that way, at least when you are having in the basket Indian rupees and Russian rubles, so considering to these two currencies, so I put the alternative as Kuwait dinar and this one. So I think definitely these two are much better than Russian rubles and Indian rupees.
Yeah,
this is my point. Yeah. Yes.
Okay, I see.
Got it.
But so okay, can I add a follow-up?
Yeah, go ahead.
Okay,
Yeah.
I'll be quick. Just because you like to work on that right now, what would you think would be the right, so if you would want to peg against like purchasing power, but not US dollar or some like these exchange wages, what would you do, or what would you use?
So these currencies are not pegged to US dollars, but these currencies are itself very stable currencies. So if you see the performance of this,
against the US dollar, right? So this is what I mean. So we want to be stable against like the generic purchasing power, I guess.
Okay. So yes, so you have to convert that into US dollar. But yes, so again, these currencies are very stable. So on such way, I like to put this in the basket. So instead of that two currencies, so it's not that I am asking to add this additionally, but instead of Indian rupees and Russian rubles, because Russian ruble is very fluctuating. So, and they are not stable. And in terms of how powerful that currency is, so in that term, I like to bring these two.
Okay, thank you.
So I think you just want to reduce volatility, right? By getting rid of two very volatile currencies, the rupee and the ruble.
Yes, exactly. Because that is our aim. So we have to make our model stable.
And if I can just add one comment there, your Kuwaiti dinar is a very interesting one because Kuwait's probably been one of the most successful oil countries to look at diversifying its income away from oil because it started from the 80s. So it does earn a huge amount of money from investment income. So that's why its currency is less pegged to the oil price than many of the other ones. Can I just ask one quick question? I know the time. Oh, thank you very much. Did you mention that you looked at the volatility based on cryptocurrencies, based on what people's perceptions were of cyber attacks? Is that what you were saying? That the volatility may come because of cyber attacks on a digital currency? Is that that Bitcoin has less volatility from cyber attacks? Is that did I get that right?
Yes. So I mean to say that that when there is a single cyber attack, so in that case, if I want to study that whether there is a spillover effect or a contagion effect among the cryptocurrencies, so in that case, what investors are doing, if there is a cyber attack, so they are holding the Bitcoin. But if you are, so if you are holding Litecoins and other coins, so in such case, there is a negative contagion. So that means it is reducing your diversification of the overall portfolio. If you are holding any other, sorry.
And they're holding the Bitcoin. Do you think that's because the market perceives that the people who are more likely to create cyber attacks are those who are predominant in mining and Bitcoin?
No, I mean, when I say this is cyber attack, means any kind of attack that is happening. So maybe you can consider it as a cryptocurrency or maybe from the government side. So if there is one cyber attack in one day, so I say it is a one cyber attack like this.
Yeah. Okay. Thank you.
Thank you very much.
All right. Perfect. So obviously, thank you, Moinak, for your presentation and those insights, right? And Harish, yeah, let's move on to the next participant.
Yeah, we can hand straight over to Ganesh.
Awesome.
All right, so let me just share my screen. All right, so thank you for inviting me. So I am at Warwick Business School, and so I will just talk about some of the issues or design issues with art. Okay, so this touches on what previous presenters have covered. So there are four things I want to talk about. One is kind of how to design the peg target. So the idea of the peg target is to kind of retain its purchasing power over time. And the second design issue is thinking about what are the optimal collateral types. So there's been a lot of discussion there of kind of whether to use gold, currencies, and so on. Then the third point is what mechanisms are in place to stabilize the peg at its target value. And the fourth is governance tools. Okay, so stable coins, as we know, typically peg to the USD. The problem that I believe Art is trying to address is the fact that you always have sovereign risk. So if the dollar does collapse, so people lose confidence in the US government, then the collapse of the dollar will obviously trigger a run on reserves for stable coins pegged to the dollar. So the idea is to have a coin that is invulnerable to this sort of sovereign risk, and the idea is for it to retain its value with inflation. And here, a couple of things that I was thinking about is one is this idea that the collateral basket says gold, fiat currencies, and so on. But it's not entirely clear how the correlation between the collateral value and inflation will go. So I think gold is obviously a good inflation hedge, but some of the fiat currencies in the basket would obviously erode in value with inflation. So that's something to kind of think about is, does the collateral value sort of go up or down with inflation? So that's kind of an important thing to think about when deciding the basket of collateral types. Then a measurement issue. So this obviously is a bit subjective. So do we use like a core CPI for the US or like a world CPI? And obviously inflation changes over time as well. So would the actual purchasing power index be sort of vary over time that you target to? So that's kind of just couple of things to kind of think about. And obviously if you make the measurement kind of a public and allow sort of time varying purchasing power index, I think that would make a lot of sense. So the peg backing, so obviously Zoran's 80% fiat, 50% gold, 5% is obviously one way to go. Another one is to be more general, so to kind of consider a wider basket of currencies, stocks, bonds, commodities. So I think probably currency and commodities are the main ones considered, but I think Nikolai mentioned stock indices as well. So that's just alternative assets to consider. And so here, the idea is to think about a minimum variance portfolio. So the idea is we want to minimize the volatility of the collateral. And so you could actually calculate the optimal minimum variance portfolio weights. It could be that it suggests that you need to put all of your sort of collateral in fiat currency to minimize volatility. So it could be that if the aim is to minimize volatility of the collateral, it's likely that you would go away from sort of Bitcoin and gold and just go back to fiat currencies. So then it becomes essentially like a stable coin, but instead of being backed by the USD, it's backed by a basket of currencies. So another point that's been touched on is the volatility of the collateral is going to directly impact the volatility of the art price. So this is kind of it's quite intuitive that that's the case. So if we take that as a given, then pegging to a basket of fiat currencies is likely to lower volatility relative to a basket of more risky or high volatility assets. And of course, the advantage of pegging to, say, the USD, yen, euro, and so on, is that you're mitigating sort of sovereign risk of one particular country. So there's still a lot of benefits to diversifying the set of fiat currencies. So just kind of a slight sort of aside. So I'm doing some current work on DAI, which many of you know. So kind of the key message of this research I'm currently doing is that the DAI price volatility is related to the collateral volatility, right? So on the horizontal axis, we've got
Can anybody hear you?
Yeah, yep.
Yeah,
So
Ganesh, we just lost you for about 10 seconds, your audio.
So let me just recap.
There we go.
So on the horizontal axis, we have Ethereum volatility. And the vertical axis, we have the volatility of the DAI peg. And given Ethereum is the main collateral, when Ethereum is more volatile, then the DAI price is more volatile. What we find is that since December 2020, DAI shifted regime. And so now they have a swap arrangement with USDC. And this is essentially where users can swap USDC for DAI at a 1-to-1. So essentially it's increasing stable collateral into the system. And then we find that the DAI peg is much more stable, right? So it's not so much a function of Ethereum volatility anymore. So this PSM is this peg stability mechanism of DAI having a swap with USDC, which is another stable coin. Okay, so the third point is the arbitrage mechanism. So in previous work, I looked at arbitrage mechanisms for dollar-backed stable coins. So along the same lines, we could, to stabilize the price at target, if the price of our tokens is above target, then you could increase the supply of collateral, borrow more ART tokens, and that should drive the price back toward target. And then the opposite sort of mechanism when the price is less than target. I guess the issues, again, if the collateral is quite risky, then there's no risk-free trade. And the actual spread between the target price and the price of ART might be dwarfed by the valuation effect of the collateral. Another point is that the global measurement unit, so let's say that it's 80% fiat, 15% gold, 5% Bitcoin. So how would you construct a unit of collateral that has these weights? And so it's the idea that a user, to create an ART token, would deposit essentially a unit of this GMU collateral. And so here, I guess this is something that I'm sure others know more than me about, but it's kind of how can you actually replicate this collateral basket as an investor to be able to like deposit a sort of GMU unit of collateral. So that's also quite important in order to do some sort of arbitrage. The last thing is governance tools. So I had a chat with the ART founders on last week, and this is obviously MakerDAO's kind of system is quite a good one in terms of decentralizing the governance. And so a lot of the parameters of the system, so collateral types, how to readjust the target index, and many other sort of moving parts, you can be set by voters depending on their stake in kind of the governance token. So I think that the system works well because we have seen kind of how the system adapts. And so I think this sort of decentralization allows the system to adapt based on user needs. And the rules versus discretion. So this is a tricky one. So obviously it's nice to have algorithmic rules, and of course, monetary policy has the Taylor rule that literature. It's problematic because in general, if you impose a rule, then the economic behavior of agents change. And so then the rule may no longer be optimal. So that's kind of formally known as the Lucas critique. So it's always difficult to implement optimal rules. So this is where sort of having a bit more like discretion in setting parameters is more useful. But yeah, that's essentially all I have to say. So thank you for inviting me today.
Perfect. Harish, can you take over?
Yeah, thanks for that, Ganesh. Thanks for the presentation. Some really interesting insights. Does anyone have any questions for Ganesh?
Yeah, I would have one actually. And first of all, it's really a pleasure to meet you because I read your paper. It was like it influenced one of my papers, so it's really nice to hear a presentation of you. First of all, you had a quite, as I understood, your idea was quite similar to the one I presented, right? So you would want to pack and not to like, it's like this idea of a synthetic pack. Can you imagine something? So the idea to collateralize DAI with USDC is like it's nice because it reduces volatility, but on the other hand, it's just like USDC in another like rope, basically. Can you imagine like some way how to still collateralize with something decentralized? So maybe just use, there are like gold-backed stable coins, could we use them or stuff like that? So is it possible to use not something centralized as collateral, but something decentralized and still get this effect?
Yeah, that's interesting. So yeah, USDC still has the problem of being like a centrally backed stable coin. So in principle, it should be possible. But yeah, right now, so I guess if USDC were to implement dollars as a type of collateral directly, so I'm not sure whether they've considered this, but I guess they've only considered crypto collateral types, maybe because of the way the smart contracts operate. They can only accept cryptocurrency collateral. But yeah, but I do agree that while, you know, right now the whole move to USD looks like a real success for DAI, I agree. If USDC blows up, then DAI basically is now vulnerable to kind of USDC risk.
Yeah, and what's the advantage? Like, why don't I use USDC then in the first place?
Yeah, so that's a good point. So it could be that people still value the idea of locking in their DAI and then borrowing off a fraction of it. So essentially leveraging their position is still an additional advantage. But I do agree that, yeah, the tethering to USDC has like implications for like what would happen if USDC like kind of has custodial risk. But yeah, I don't know whether whether there are other stable coins that could be substitutes. I think probably there are political reasons as well why they want to go with USDC in terms of like getting market share in the stablecoin space.
Yeah, perfect. And one other question. So because you talked about minimizing the volatility of the portfolio, so this, but again, also there, it would seem to me that it's like minimizing volatility against the US dollar, right? So could we somehow minimize volatility against these CPIs? This should be possible in like as well, right? It's just like switching the sort of the thing that things is priced in, or the thing that the portfolio is priced in.
Yeah, so I did not think of that, but you are right that yeah, the volatility is thinking of just dollar prices of all the collateral, and then minimizing the volatility with respect to dollar prices.
Because in best case you would just use dollar, right? Because dollar to dollar is 1-to-1, they're perfect with that.
Oh, right. Yeah, that's a good point. Yeah, so I agree that it could be like relative to some purchasing power index.
Yeah,
Then
this would be better, I guess.
so that would make more sense. Good point.
But
Can I just build on? Can I just build on Ingolf's point actually, and maybe a point made earlier, slightly from Moinak's as well. You know, everything being pegged to the dollar has some inherent risks because obviously the US is borrowing at a rate which is fairly extraordinary for political reasons as well as for their perception of economic reasons. But it does mean that we are disproportionately putting our anchorings into the hands of something which we have no control over at all. That's the first thing. The second thing is it's also happening at a time when the US, the thing that's kept the US dollar value high or highest is because of they don't face domestic inflation, which has allowed the real economy to grow independent of what levels of budget and trade deficits they have. But that was based on the fact that until 15, 20 years ago, 35 to 45% of all world imports were priced in dollars because, you know, they were the biggest importer. And so all commodities were priced in dollars. But actually, as their share of global trade and purchase reduces, people may start to look at other ways of pricing global commodities. And so suddenly the danger is we don't see a smooth decrement or a smooth increment, but the moment that people start to see this is starting to change, you will see a massive shape. So a massive sort of decline or, you know, so actually looking at, you could end up actually having inflationary risk in a deflation world if you're disproportionately anchored to the dollar over the next 10 years.
Yeah, so I agree that the event of a collapse of the dollar, right? So this idea that they have this exorbitant privilege, but then people lose confidence in the ability of the U.S. government to repay debt. So that would trigger a big depreciation, and that should increase inflation. So increase inflation risk as well.
And sorry, just connection on that because I'm not even going to that delimit here because in fact let's make the assumption today that everyone knows that no one's going to be able to pay back the debt. The question is about the cost of rollover. And so let's say that actually there's a sort of 15 to 25% deflation. Devaluation, depreciation of the dollar in the next several years, which let's say it's not going to create any political instability, but just from a simple, narrow focus of whether your basket holds its value or not, it does have implications.
Yes. So, that's right. So the collateral value would go down. But yeah, I do agree that the rollover risk is like quite a real. It's a good reason to diversify away from the USD as collateral.
But on the other hand, if you have something like you proposed sort of this pegging against some CPI, you probably would have margin calls for the collateral. So this would need to be covered quickly. There is some risk left, of course, but you can mitigate it. And yeah, I would say it depends on the liquidity of the market and stuff like that. But it's interesting study to model that. Yeah, it's not like not a completely new setup, I guess.
No, and the margin call on that, that's an important thing, but actually it is something to explore or test because we don't need any geopolitical risks or no collapse, none of these sort of really extraordinarily emotional words to imagine why it's very rational to have a 15 and 25% sort of depreciation in the dollar. We all carry on. We all still live and love, and the sun still shines. But so we need. I think this is something that everyone who disproportionately pegs to the dollar has to think about. One of the things that the dollar is benefiting from is Churchill's sort of comments on democracy, that it has many problems apart from all the other systems. But that's not a reason why it will perpetuate indefinitely. We may end up having things priced in different currencies in different places, because of those who are pricing their resources in commodity, in dollars, will start to have to work out. They don't want to be the ones who are disproportionately taking the hit for things, because they're paying people in their local currencies for salaries and stuff like that. So I think it is something to think about.
Okay, perfect. Does anyone have any other question?
Yes, I will have one question or comment regarding the part of the presentations about the rules and discretion. I can agree that it is impossible to have an optimal rule, but you also have a lot of problem with discretions in terms of credibility. Should you completely exclude rules, at least at the beginning, because art for an ordinary people will be just one of the more than just more than 1,000 cryptocurrencies. I think that it shouldn't be bad, that at least at the beginning you will have some publicly announced rule that will increase the level of transparency. And just regarding your comment about the rules and discretions in the central banks, I will add that the central banks prefer rules in the stable time and discretion in a crisis time. Thank you.
Yeah, I agree with your assessment there. I think it's the transparency part. So I think, yeah, like listing collateral types like weights, they make a lot of sense. But I guess in terms of updating parameters, I think that should be allowed to be more like discretion through votes of a committee, similar to like the MakerDAO system. But yeah, I do agree that, yeah, like in crisis periods, yeah, discretion is a much better way to go.
Fantastic. In fact, I think one of the key takeaways here is that how the governance is playing a role, and how much of it should we define, and how much of it should we keep it algorithmic, self-sufficient. Or
just one thing. I think what is the governance, the relationship between rules and discretion, or if I can put it in a different way, the relationship between rules and some sort of dynamicness or future-footedness, I think is a really interesting one. And whether you always have a blend or whether you transition from one to another is, I think, also an important one for us to consider on going forward.
Perfect. So great. So does anyone have any more questions? Else we move on to the next participant. Great. Harish, can you take over?
Yeah, we have Darko last.
Okay.
So it's been a long wait since he mentioned to Heldger that you will talk more in his presentation, but
no problem. I didn't forget. Thank you anyway. Thank you. Hello everyone. I will share my presentation now. Just a second. Okay, to find. So I hope that you can see now this.
Yeah.
Okay. So just firstly, one short overview about US dollar and other currency that are in the basket and what happened in the 1 year and their volatility. I will not hold too much because later I will express my opinion why I will not speak too much about the currencies. But anyway, we can see here that mostly euro were more stable than dollar, US dollar in the last year. Then comparison with the Chinese yuan, something around the value, not too much. Indian rupee, Swiss franc, then the British pounds, Russian rubles that depreciate a lot around in last year around between 25 and 30%, and Canadian dollar that appeared a little bit stronger than US dollar according to this data. firstly, I will speak about the gold. How is the gold less risky or not? As we can see, the last 3 years, the gold price broke 3 times the right shoulder. And during the 1 year, this volatility range, firstly from 1.5 thousand, after that reached almost the $2,100 and then decreased on 1.7 thousand. So according to historical prices during the year, gold is a little bit more volatile that many investors, especially investors in the risk-free asset will think. So what will be the next? About Standard & Poor's, I said even in our previous communication during our single meeting that I'm rather for Standard & Poor's than for the Bitcoin, mostly because of the reason that Bitcoin is extremely volatile and very speculative. And in the last few days, we saw why. Because of this price depreciation. But even the Standard & Poor's 500 could found a better solution. For example, there is the one possible substitute. It's the Standard & Poor's 500 low volatility index. So even the returns are lower during the 1 year, for example, this index is more stable because it's connected only to the low volatile equities. And in the beginning, when we had a shock from the period of the crisis COVID in the last year, actually we can see that even both they are by the returns because of some of the companies' negative returns in Standard & Poor's 500, this Standard & Poor's 500 low volatility index presented the good results in this period of time. Even more, there are much better possibility for indexing. It's the defensive sector of Standard & Poor's. So as we can see on these several crisis events, these defensive sectors behave much better, and they could be some kind of the substitute for the Standard & Poor's 500 index. So healthcare, utilities and consumer staples, they are always quite stable. And in the case of the event, I am not expecting that it will be the negative, because it wasn't in previous. Only we can expect that it will get more market capitalization and more possible transfers from the risky asset to this defensive sector. So this one could be also one of the solution. For me, one of the very interesting things when I checked returns and the volatilities of different kind of assets, I found between all of these mostly used assets that international actually bonds are one of the most stable in the last 25 or the more years. I derived only this asset, so it's a Vanguard Total International Bond Index Fund Admiral shares, and this is the ticker VTABX. So only in the 1993-4 it was some small negative return. After that, all these years after that, actually it was the stable with some positive returns, depends of the time. So even during the crisis, this VTABX show good performance, and it could be included in the JMU as one of the potential asset. So more to express this VTABX, we can see that it's a very low risk. It's not the least one, but it's very close to the least, the number one. This is the hypothetical growth on $10,000 that is projected from 2013 till 2021. It's quite good. And what more? The more is that mostly depends of the Europe and Pacific region. So it can be some kind of the offsetting to the USD, especially because it's not connected with American the companies. So this is the structure or distribution by the credit quality. How is inside of the VATABX, and this is really my proposal that can be considered. So this is the formula that I can, for example, just rearrange a little bit. I decreased from 0.8 to 0.7 basket of the 8 currencies. Now I will turn back from the beginning what I said. So it's not the problem to research what kind of the basket can be included. And I can say that I'm also satisfied and agreed with the team of Professor Grubisic for their proposal. But for this part of the gold, I propose to be decreased on just 10% because of the yearly volatility that expressed, then 10% of the VTA BX and 10% of the Standard & Poor's low volatility index, or this defensive sector that I previously presented. So what I can see for the governance here, there are two things. One is the firstly, this GMU should be seriously tested. That I can also agree with the Moinak of portfolio optimization, not in the dozen, maybe even the hundreds of the of this GMU. Sorry, what happened here? Aha, okay, I just switched off. It must be seriously tested in the different scenario that we can be sure how we will perform according to returns and the volatility. And the second, what I think it will be more interesting and more influence on the MahaDAO or art is actually market demand and behaving on the market. So I found only one serious news about the MahaDAO that was published in the Yahoo Finance around somewhere in the middle of the January, and in that period of time, it was the highest of $24 per one MahaDAO was actually the price. I cannot say that it's connected with such news, but until the Bloomberg will write or their specialist something about the cryptocurrency of MahaDAO, and after that, I'm quite sure that many of the journals and the magazines will overtake the news, because this is what they are doing, and sharing between will influence on the highest demand and to be interesting in this cryptocurrency. And before that, this capitalization of the a little bit more than 8 million actually is not enough to be visible in the first 300 their cryptocurrency that have more than 100 and something millions of the capitalization. I'm not comparing with the first 5 or 10 with several billions, but I'm just saying it's necessary highest capitalization and maybe some even connections with the Bloomberg that can share the news and to introduce to investment publicity that this demand will be the most market, the most important, not just the GMU, what is inside. Actually, this behavioral part of the finance, I think, will influence more on the price of the MahaDAO. So this is something of these two things that governance should consider in the future. And of course, seriously portfolio testings and constructions to see behavior of this time data series, how what will be returns and the volatilities and many other things. And that's not the problem, because you can find in the Bloomberg and you can construct and test in different scenario during crisis or in the good period of time, normal. So all kind of scenario, it's possible to get insight and to create such kind of the testing. So I hope that I said shortly in this 10 minutes.
Yeah, that's fantastic. Darko, obviously, thank you for your presentation and obviously your insights, and also particularly the inclusion of bonds I found was very interesting in the basket. So, you know, opening it up for questions that anyone might have for Darko.
Well, I would like to express our sincere gratitude for the all participants for these nice comments. There are many nice ideas to improve the GMU and its stability. Just a slight comment, maybe, that I don't see Bitcoin as our competitor. Bitcoin is more speculative, as several people here mentioned. So it is a growth-oriented investment, speculative coin. It is as opposed to our idea, which is value-oriented investment. So it is not a competition, it is just a representative of risky assets, and the idea to include it to represent these spillovers from risky assets into the within global measurement unit. Just a comment. And of course, I remains at the idea to combine these currencies and some global commodities. I think it is the only way to hedge mutually, simultaneously against all these risks. Inflation risk on the one hand, currency risk with this combination of assets, and of course volatility risk. So this is the only way, the combination, the proper weights. There is no ideal scenario. By me, there is of course no ideal composition of the GMU. There were many nice ideas here. I think Darko's ideas to include, for example, these bond indexes is really nice trial. So this is just for me, there is no specific question for the audience, for the participants, just some kind of comments, because my team established the draft version of this idea of GMU. That's for my side. Okay. Thank you.
And the same comments go from my side. I think it's very interesting for having the bonds in the GMU, and also the elaboration on how the volatility is going to play out as well. So anyone else have any other questions? Else we move on to the next segment. Yeah.
Maybe quickly, I really also like the idea of like how much to going to equity and bonds in that depth. I wanted to ask you, so in this event that Suhas is concerned about, so devaluation of the US dollar, how would these international bonds behave, would you think? Because of course, I guess there's probably also like a high constituent of dollar, like dollar peg, or not dollar peg, but dollar issued bonds, and it's probably like a complicated question, but usually like bond values depend on interest rates, right? So how would you think about this model that US dollar just depreciates?
Okay, thank you very much. They will behave amazingly good. That's the reason why I propose them. Actually, firstly, they are not dependable of the US dollar, and they are non-American companies inside. So during the many crises that I found there, when there were negative returns even on the bond markets in the US, these international bonds index has around +5, sometimes 7% of the returns. And not one time, this happened many times during the different negative events. So because of this reason, it will decrease dependency from one side of the US dollar. And when we speak about bonds, I just want to say strongly to not include the treasuries. I found that treasuries are seriously dangerous to be included, especially because of the negative returns and even the very low returns, and it will not be they will not satisfy the inflation rate of 3 or 4%, even if they will have some kind of the maximum between maybe 1 and 1.5%. So I found that treasuries are not a good option. That these international bonds outperforming all other bonds in the last, for example, 25 years. What will be in the next 25 years? Well, I don't know. We cannot know that. But in the period of time in the next investment horizon of 5 years, there is no reason that they will not continue to perform in the same way. So that's the one thing. And the second thing that we didn't discuss is that US also dollar is not positively correlated with the euro, and sometimes they are offsetting each other. So it's a good idea that it was previously proposed that to be in some kind of the similar proportion, because mostly they are not positively correlated, and that's good actually to decrease the risk of this currency. Anyway, thank you, Ingolf, for such kind of question. I like that you asked me this.
I think it's interesting, really.
Can I just build, Darko, thank you, on two themes actually. So one, taking up on what Ingolf was saying. So we have two. One of the things of doing analysis in the last 10 years on how empirical analysis and correlation analysis on how things are valued is separating out correlation and causality. And I do worry, actually, because of I feel that a lot of the conclusions that one can make from the last 10, 15 years are really are very unstable for predicting the future. So if we think quantitative easing has been very, very important. So just to make it very clear, my comments on quantitative easing aren't to say it shouldn't happen. It's more to say, how do we mitigate against the fallout of it? If the idea is to create something that has stability. If it's not, then it doesn't matter, of course. So many asset prices, equities, also bonds, all sorts of things, cryptocurrencies are determined because of the ability to print money. And the ability to print money is not based on rules in the sense that it's also based on everyone in the world wanting it to happen. So there's a mutual incentive and the prisoner's dilemma in some ways. There's a game theoretic rationale for it. And also, one of the main purchasers of government bonds are pension companies who statutorily have definitions of what are safe assets, even if they lose money. So that particular requirement from pension companies has allowed central banks to print money, buy their own bonds, and control the yield, control the interest rate. In any other market, we would run away from this. So there is an inherent assumption here that pension companies' members, us or younger members of our cohort just now, their parents, will continue to support this. So this is one thing. The second thing is, the other pillar is lots of other anchors for valuation somehow end up trickling back to the decisions made at the Federal Reserve or in the White House and Congress. So in some way or shape or form, you're still back to the decision-making and governance in the United States. So, for example, if the interest rates in the US rise quite rapidly, let's say, because they're going to have large deficits and trade deficits as well, both deficits, you could start to see the credit market across the world actually pricing risk quite differently, because they will disproportionately hit what they consider as micro default risks before they look at macro default risk of the United States. So you could actually see a disproportional effect on corporate bonds, although they may not be at all bad business risk compared to the rollover risk of the United States. But it's the way that the markets would work. So that's another thing that I think one needs to take cognizance of. The final point I would make is, if one really wants to have an idea of how the global world is doing, the global economy is doing, and have assets, let's take a currency or a stock market, to show or gauge the health of the global economy, one might think of something like the euro or the Swiss franc. The reason is because both areas are having a depopulation. So if you think on the influence on GDP, their populations are having a decreasing effect, not increasing effect, which means that they are more proportionally dependent and reflective of what's happening in different parts of the world. Now, the DAX is a very good example, the German equity market. If one wants to have an exposure to EMs, particularly Asia, but wants to have it in a safe way, one step removed type of way, the DAX is a phenomenal example of this. And there are many German companies that are a good representation of where the world is going by where they've actually increased their market share and size. So take Volkswagen Group. Volkswagen Group is one of the first global companies in the world who has become the largest unit sales and producer of cars without being number one in the world. Prior to this, anyone who became number one in the world first became number one or number two in the United States. Volkswagen is about number 4 or number 5. And the reason why they've become number one in the world is because they're number one in, in China. They have very leading positions across Asia. And German cars are sort of 19% of the new car market in China, which is the world's largest car market. So, this is a very interesting place. Switzerland also, when you think about governance, if the Swiss currency, if the Switzerland was to say that, we're going to create a digital currency for the world, we have a fiscal surplus and we have a trade surplus. No matter how valuable the Swiss franc is, we still manage to maintain the two. We are very small, so we're not going to get involved in having arguments with people and political spats and sending in militaries and armies. We will treat you with fairness and maintain your privacy, and we have credibility for this. So we have rules, but we also have intangible credibility because of the way that we have managed the world's money, regardless of whether you're corrupt or not corrupt or whatever else it is. We've not been discriminated against you. And so if they were to release a currency and say, you can maintain your privacy and you can still trade with each other, and your currency, we will be protected from state or non-state hacking or cyber attacks, because everyone needs to raise money. And look at the history. We have credibility. In the Second World War and the First World War, both sides never invaded Switzerland because they both needed to raise money for the war. I used to live in Switzerland, and I know there was a political party who had once talked about how the Swiss army had managed to keep the Third Reich out, which was politicians come out with all sorts of interesting and quite humorous comments at times. But there is credibility. So there's credibility on intangible, there's credibility on conventional rules and fiscal guidance and those kind of things. And you can sort of, even on a layman's terms, you can think about it and say it sort of makes sense.
Okay, thank you
So
very much. Yeah.
People's thoughts. Yeah.
You said to me a lot of information and words, and in different kind of questions. I will try to answer as much as possible on many of them.
Please.
Actually, yes, sure. And if I miss something, please remind me. So, I will start from the last one about the credibility. So this is very important. I also think so that even that the Swiss government will launch the cryptocurrency, everybody will believe that this is very stable because the Swiss is behind, and the credibility is in this behavioral part the most important thing that everybody will follow this. According to these companies and especially the bonds on the American market, this is the reason why I suggested VTA BICs, because they are out of US, the companies. And from other side, we have this defense industries Standard & Poor's 500 in the same percentage of 10% of US companies, but they have these companies actually, they presented the positive returns even in the period of the crisis when the Standard & Poor's 500 were decreasing sharply in that period of time. So you presented, and the main idea of MahaDAO is to be some kind of the stable coin, not the speculative coin. And in such way, it's better to think how to get maybe 5 or 10, 12% per year of the returns that are the sure and stable, than to compete for the 70% and to take such kind of the risk. And from other side, these BTX actually will be some kind of the dollars offsetting on the companies, and I think they are not so dependable of the dollar, because the history show that they behave different in different scenario with American corporations and the dollars also. And what was important thing? Yeah, you asked me about these currencies, and is it better to present them as their correlation, or to take other factors also? Well, it's impossible now to answer this question, because this will take months of the serious researching and the testing that we can know this. I'm quite sure that you are right in this question, and they are much more than just the simply of their correlation, until we enter the insight on many other of their behavior and to see what influence, taking a lot of factors. So, but I can just say that this is the question for the research that will take time for this, and so I cannot answer quite strongly on this question. Only that I agree also that there is probably something more than only the simply correlation. Did I miss something more? Please
No, no, that's fine. That's great. Thank you.
Okay.
Great. So I think so. Obviously, thank you, Darko, for that presentation, and of course the answers. I think that was really interesting. So now, guys, in the interest of time, right? We have about, I would say, 12, 15 minutes or so, right? So would like for the panelists, right, to give a few words or ask questions, keeping in mind that we try and keep it as brief as possible. And of course, for the participants to also keep in mind, if you can keep your answers as brief as possible so that we can conclude, hopefully, without too much of a delay. And obviously, thanking all the participants once more for their wonderful presentations and, of course, the enormity of the ideas that have been shared today, right? So to start off with, obviously, would like for Lisa to, say viewers a few words or ask a few questions on whatever has been discussed so far, and then we can move on to the next panelist and take it from there.
Absolutely. So thank you all six of you. Very, very great presentation. I made a lot of notes and amazing presentation. So I just have two simple questions that was not exactly talked about yet, because I understand we're talking a lot about the basket of goods, we're talking about GMU, and the output or the goal of this entire GMU is to figure out how do we get a stable coin, stable value. And I think there are two topics that we have not discussed yet. The first one is how do you account for inflation in the basket? Because when we're diversifying, there is value increase, and how do you account for that in the stable coin? The second one is what happens when what happens when the stable coin is less than $1? I know there's a lot of conversations around arbitrage and removing liquidity. That's very dependent on the secondary market. That's very dependent on the other type of people doing that. What can be done within the system, within the mechanism, in the monetary policy that can be embedded? It could be in governance, it could be in code. What can we do to help restore the peg to $1?
Okay, anyone who would like to take that up?
Okay, I can take a note. Just the idea behind combining these global commodities, gold, Bitcoin, with these fiat currencies is to hedge against inflation. So this is the role of these global commodities. And on the other hand, of course, there is a volatility risk, market risk of these prices of these global commodities. And I think this contribution of Darko that mentioned with bonds, this composition is really nice of that index. It not only consists of US dollar, but of some other bonds, and there are real positive interest rates.
Yes.
In the long period, which is very important to hedge against inflation once again. So just one comment. Okay.
Thank you, Zoran. Can I also just a few things to answer on the Lisa question, actually, especially on the second one. I think that the monetary policy will not strongly now influence to return the value of the coin, and it will be more for the market reaction. If you succeed 2-3 more stories in the Yahoo Finance and even in the one in the Bloomberg, that will very attract publicity, and it can influence on the higher capitalization, and higher demand for the currency will influence. I don't know how much to restore the value, but it can restore. And one very important thing we didn't discuss on my some kind of the personal meeting that we had previously. I said also to Stephen and to Harish and to Suher about stabilization of the now in this moment of the coin. So in the first moment was some kind of the appearance with the highest value, and after that it passed 2 or 3 months when you had some kind of the stable now the trend of the coin. But the reason that it's lower actually I will not so consider as a big problem in that moment. The most important that is not going any more down. So let's see in the future, in the next 2-3 months, that maybe we'll continue in this trend, or definitely if it will be a lot of attraction and the news about it, I'm quite sure that will increase capitalization and higher demand that will push price up.
May I add something? Well, about the inflation risk, I would see with good eyes the introduction of real commodities. So if you want to hedge against inflation risk, the best thing is to invest in the real economy. So not oil, because it's, I think it's the second more volatile commodity in the world, but other commodities. It would be nice if we have an index of commodities here. So this is the first point. The second one is that we have to look at safe haven assets. And we can't discard gold and Bitcoin. So I know that the volatility of Bitcoin in the short run is quite high, but as the things are, if we believe in the long run trend, the best thing is to have Bitcoin there. And also the correlation between Bitcoin and other traditional assets has been historically low. So why not Bitcoin? Probably reducing the weight of Bitcoin in the portfolio, but still maintaining a part of it. Now, I think, I don't know who talked about it, but I also agree with using the minimum variance portfolio construction. I think it's the best one. With we can do an algorithm with positive weights and check, because in the long run, what happens to the minimum variance portfolio is that it beats all other portfolios in the mean variance framework. So that's happened. Why not here? Okay. So we have to look at safe haven assets. We can't discard Bitcoin and gold. They have to be there. And we have to create a rule to get the weights. So otherwise it doesn't work. And we have talked here about transparency. Now, if you want to maintain the stable value of the coin, you have to be transparent. Otherwise, at some point in time, can happen a crisis of confidence and everything is lost. Now, Darko talked about the early days of art. Yeah, of course, because it was the beginning. No one knows what was going on. So there is a lot of volatility going on, and you don't know what's going to happen. At some time, people will relate the value of art with its fundamental value. Now, the question is, what is the fundamental value of art? We don't know. So, well, at some time it will stable, but it will not have a parity with dollar because we don't know the fundamental value. So that's one thing that we have to think about it. So that's my views.
Isn't the fundamental value coming from the basket of goods, the GMU?
Yeah, sure.
Once we have it. So that defines the basket of goods.
So we are publishing that, and what is the value in US dollars? May I ask you? What is the value of the underlying asset in US dollars? That's the main point. Because if you pass the message to the market, well, people will look at the art and say, well, it's it's undervaluated or undervaluated according to its fundamental value. If that message passes to the investors, at some time, arbitrage will take place.
Yeah, so in that sense, do we change the percentage and weightage of the different kind of the proportion of the basket, or do we allow arbitrages to come in to rebalance that? Because it's not, it can be dynamic. It doesn't have to be 0.8% or like 80% and 20%.
Well, the thing is, you have to maintain some stability in the weights, but at the same time, you have to rebalance the portfolio. So I was expressing myself saying that, well, why not quarterly? Okay, so it will have some short-run stability in the weights, on the composition of the underlying asset, but at the same time, you will follow what's going on in the market. And if the idea is to hedge against several risks, okay, so you have an algorithm creating those weights and trying to do the best to hedge those risks. But as I said before, you can't do it to all the risks going on. You can't hedge against the price risk, against against the inflation risk, against sovereign risk. You can't hedge against everything. So what are the main targets here? What are the risks that you want to hedge? And according to that, you create an algorithm to compute the weights. That's my idea.
Adding to that, I'd like to throw into the ring again this idea of a synthetic peg, because there you would, like look at your target, your objective to keep purchasing power stable, and directly go to that and just collateralize a sufficient amount of other assets to achieve exactly that. So it's more complex in a way than just, or it's more complex to communicate the stable value maybe than if you peg to something like bonds or assets that are used in the financial world usually. But on the other hand, then you get rid of a lot of other problems. So another thing is that to a second question actually with peg deviations and how to restore peg, I think it is actually the arbitrage that you really want. So you want as much, you don't want to correct it yourself, but you want to open up arbitrage possibilities as to many market agents as possible. And there maybe also should be a focal point that if you, like either if you collateralize something like bonds, you should still open up people to like arbitrage against the peg that you have there. Or if you stabilize against some synthetic way of like the CPI, then people should be able to speculate against deviations there on using Ether or some other collateral.
Using Ether or some other collateral. So by adding or removing additional collateral in the basket.
No, it's the other sort of these two options. Either if you have assets like bonds in the basket, or you do it centralized and do it like DAI earlier. Just maybe not Ether as collateral, but something more stable. But that's what was Ganesh, if I correctly pronounce that, was talking about that. That if you have collateral that is stable, then also your peg gets, of course, like has more volatility, or your price is around the peg. But on the other hand, you have to find something that is resilient that you use there.
Yeah, just to add to Ingolf's point. Yeah, so I also believe that, yeah, the arbitrage is obviously the best way to stabilize the price. I guess right now I'm not entirely clear on how the arbitrage is done. So the idea is to have a collateral basket. Let's stick to the sort of fiat gold Bitcoin. Would the idea be to have the say an investor deposits collateral in this 80%, say 15%, 5% weights. So essentially they're collateralizing a unit of the GMU, and then the collateral enables you to borrow, say, ETH tokens at the target price. And then when the secondary market price deviates from the target price, then you can essentially change your collateral accordingly to then change the amount of ETH tokens, and that will kind of cause the ETH price to go back to target. So if the ETH price is above target, then you would want to deposit units of GMU collateral, borrow ETH tokens, and then that increase in supply drives the price down. And then the opposite case is if the ETH price is below target, you want to sell collateral and reduce your ETH token supply, and that will shift the ETH price up toward target. So I guess here, so that makes sense in theory, but here, are you able to construct a GMU unit of collateral? So I know that they're like wrapper currencies, like you have WBTC, wraps BTC, and I'm not sure, is there like a wrapper for gold and then a wrapper for other currencies? And so then each unit of GMU sort of forces you to invest in the wrappers of each of these cryptos. So that would at least force the investor to invest in the collateral basket that's been designed, as opposed to DAI, which allows users to be quite flexible in which collateral they go into, although they do some caps to kind of prevent people from just going into one. So I guess, yeah, my question is, do we, is there a GMU unit of collateral that sort of investors have to invest in? And I guess assuming that's the case, then the problem is this arbitrage is obviously depends on the volatility of collateral, right? So the problem with DAI and Ethereum collateral is that Ethereum collateral is super risky. So the valuation of Ethereum is always going to like dwarf any sort of spreads between the DAI price and the USD. So similarly, if you do have a basket with gold and Bitcoin, although you achieve like inflation hedge, it's hard to arbitrage because the collateral is always going to fluctuate a lot. So I guess that's kind of the main difficulty in kind of that so obviously there's a trade-off. So you can achieve kind of inflation hedge, but then I think it's harder to maintain a price at target as a result.
Got it. So I think that sort of answers Lisa's first question, but her second question is still unanswered because I think it's still pretty new for, there's this concept called as PCV, protocol controlled value or liquidity, which could, be answering the second question that you mentioned. But definitely, I think a lot of the participants and panelists here have expressed various ideas on having different components, a portfolio that is optimal, or having oil, or reducing gold, or having bonds, etc., that would fight the inflation. Combined as a whole, should possibly fight inflation. So great. Yeah, as
I understood, Lisa asked in the first question how to measure inflation in this GMU basket. And right?
Yes.
So yes. So I think that will not be the problem, because we can take from all of these countries according to the ponder how they are by the percentage about their percentage actually in the basket, and we can measure this plus to give some small percentage, for example, for any of these indexes. So I think that could be between 3 or 4% maximum per the year that you can take as a inflation according to these countries. So you have the minimum around 7 or 8% of the returns to cover this risk and to take some positive returns on this.
Yeah, so when you say take some positive returns on that, does the inflation then, the positive returns, which is the inflation, does it go into the system as in new earth? And
actually, the inflation is already negative, something that you can consider and that you will lose. So this free, for example, percentage is something that you will take as the risk that you will have per year. And so you have to satisfy minimum of this 3%, plus after that to have more returns depends what is your goal in such kind of the investment. So if you have the stable some kind of the coin, several more percentage are quite fine to continue to rise some small stably. But if you want higher investment, of course, in such case, you have to consider much more risky asset and to be involved in such kind of investment. But 6, 7 or 8% are quite fine to satisfy the inflation and to get some small positive return on this.
All right, perfect. So Lisa, is that your question's answered? So
yeah.
Perfect. Awesome. So great. So then, I think I really do want to respect the time of the participants and the panelists. So would request if the remaining panelists can just give closing statements, and then we can sort of conclude, and then take on future discussions either offline or in another call possibly, right? So it would be great if Professor Zoran can say a few things, and then Karan, and then Suhas, and then we can conclude. Yeah.
Okay, thank you. There were many nice ideas here. I would like once again to express our gratitude for accepting this invitation and for express this contribution. So I think we really need to more deeply analyze all of these ideas. There are many interesting ideas by including some other currencies, for example, and to exchange, to exclude some other currencies. We have to test this idea and to combine, to find the best way to combine. Regarding this minimum variance portfolio, I think it can be accepted, but only for that part of global commodities, for gold, Bitcoin, not for including currencies, because the result can be in the opposite way, that only currencies should be included. So that these other global commodities should be excluded. So there are many interesting ideas, and we need to test it. This is my final comment. Okay, thank you.
Perfect. Karan, can you say a few words? Yeah.
Sure, happy to. I think it's really an interesting question whether we should go with an entirely fiat basket or a basket of fiat and commodities whose value really is linked to fiat, but also moves independently of fiat. So I think that's an interesting question. I think Ingolf brought up a very interesting point, which was the focus on precautionary money demand, which essentially means you're looking at a risk-averse population to be the core adopters of this stable coin, if that's the way that you go. And I think that's very interesting because that obviously most people wouldn't describe crypto investors in that way. And I think this would provide a very interesting sort of differentiator for this stable coin, to look at it that way, that you focus on precautionary money demand and focus on risk minimization in the way that the stable coin holds value. And again, for the commodities, the interesting question is, do we choose the commodities based on stability of value, which is what a lot of people have suggested? Or do we choose the commodities based on their use value, which is what Ingolf, for example, was gesturing towards with the synthetic basket of simple goods? These are commodities that people actually use in their day-to-day lives. And that's also an interesting question, a crossroads of which way to go there. So that's quite interesting.
Okay, awesome. Thank you, Karan, for those words. Would it be great for Suhas to say a few things? Yeah.
Thank you. Thanks to all the participants. Really thought-provoking conversation, and appreciated the back and forth. There's many very important threads to take away. I mean, for us, but I think also hopefully for the participants as well. I will just sort of summarize 2 or 3 things that I'm sort of, I think, continue to, I suppose, provoke me. One is, we've got, what does one anchor to? The real economy or to the valuation of financialization? And financialization is a product of quantitative easing and speculation and so on. Even precautionary demand is expanding into new categories of things because of its concern related to asset bubbles. So it may be looking to diversify the assets itself in the process of which it's creating another bubble, but then it has more choice. So if one looks at the real economy and demographics and extraordinary levels of new supply that comes on stream, let's leave aside the volatility or the bottlenecks that may come up in the next year or so coming out of the pandemic. There may be an inherently built deflation to anything. So that's one thing. The other thing is on the governance and the role between rules and discretion, and how this interacts and whether you migrate from one to another, particularly if one thinks that the future isn't an extension of the past for a variety of reasons that we touched on in the one-to-ones, then actually having something that's future-footed is going to matter a lot, because if you have models based on the past, then the transparency will mean that you will be seen as being open, but just irrelevant. And so you're not even a player. So that's, I think, the second thing. And the final piece is the geopolitical risk and a relationship between distributed/decentralized and the consortium. And whether when people talk about decentralized, do they mean delegated or genuinely distributed? So I think this is a very important area as well. So I look forward to engaging and interacting with everyone, either, as Stephen said, on one-to-ones or in other formats. And thank you very much for your spirited time now and in the previous one-to-ones as well.
Awesome, great. Andreas, it'll be awesome for you to say a few words, yeah?
Yeah, I think the GMU design considerations were very interesting. One actionable insight, though, I think that's been brought to light today was that creating utility for the token is a very big deal. If you can manage to have this token, if you can go out and buy groceries with this token and have it and be aware that it is somewhat stable, I think that would be excellent and would add great value to the project. And I think the more of these deals that could be struck, the more you can also make people believe that this is truly meant as a currency and not an investment tool.
Perfect. So I think this is it. Thank you all so much for your time. Harish, can you just conclude and give them all a break?
Yeah, I know it's been a while now. Just to echo what's come before. Thanks a lot, guys. We'll probably follow up individually to debrief. Could I kindly request that you do send me any materials, i.e. the presentations, and we'll discuss with the panelists and follow up with next steps, if that sounds good. But until then, enjoy the rest of your Sunday and Bank Holiday Monday as well. So thanks very much, guys.
Thank you all for participating.
Thank you.
Thank you. Thank you.
Thank you, everyone. Goodbye.
Bye.
Okay.
Bye.
Bye.